Unshakeable, Your Financial Freedom Playbook by Tony Robbins. Don't be scared of your money matters. Instead, take control. In your 20s, it might seem like you're handling your money well if you can afford a place to live, buy food, and pay your bills. But what if you want more than just getting by? Chances are you won't be able to rely on part-time jobs forever, and you may not want to rely off of that level of income. So, how can you make sure you can buy a home, support your children's education, and have a comfortable retirement? Even if these goals seem far off. Hey, that's something old people worry about, right? I'm in my 20s, we don't need to worry about that. Hey, it is smart to start saving and investing just a little bit right now. Your future self will be grateful. Compound interest shows that it is never too early to start investing. Financial markets can seem complicated and sometimes scary, making it hard to start investing. Let us first understand some basic ideas to make investing easier. To succeed in the markets, it is important to spot patterns. We, as humans, naturally notice patterns and use them to plan our actions. For example, we learned to understand the changing seasons, which helped us plant the right crops at the right time. Financial markets are similar. By observing, you can spot patterns and find the best seasons to invest. One simple pattern is compound interest. It is the money added to your initial investment, which keeps growing your investment over time. Because of compound interest, it is smart to invest part of your paycheck as soon and young as possible. The longer it grows, the more it is worth. For instance, imagine that since you turned 19 years old, you invested $300 per month. That's $3,600 a year. Based on the average United States stock market return over the past century, your investment grows by 10% each year. By the time you are 35 years old, it would be worth $106,782. But if you waited until you're 27 to start investing, by age 35, you would only have $53,775. That is almost half of what you could have had by starting 8 years earlier. Clearly, it is important to start investing as soon as you can. Focus on preventing losses rather than making huge, massive profits. And remember, the market is unpredictable. Starting early is fantastic, but how do you tell a good investment from a bad one? Experienced investors follow the core 4 principles to help them with this. First, concentrate on avoiding losses rather than making money. Of course, nobody wants to lose money, but investing involves some degree of risk, and you need to understand how hard it can be to recover from losses. Imagine you invest $1,000 and lose 50%. leaving you now with $500. You might think gaining 50% will bring you back to where you started. Hey, you lost 50%, you made 50%. But that 50% gain on your now $500 gives you only an extra $250, totaling $750. To return to your starting point of $1,000, you would need to earn 100% of the now $500. That is why you should choose safer investments with limited downside. Another tip for avoiding losses is realizing that no one can predict financial markets accurately. Even the most skilled and famous investors do make errors. Ray Dalio, the founder of the well-known investment firm Bridgewater Associates, is a stock market star. But in 1971, he learned that predicting the future is a lot harder than sometimes people think. That year, President Nixon took the United States off the gold standard, causing the dollar's value to drop. Everyone, including Dalio, thought the stock market would fall as well. But it didn't. It surged. From then on, Dalio knew that predicting with certainty was impossible. That's why experts know they must make investments that can withstand unexpected market events to avoid losses. When investing, strike a balance between low risk and high reward, and use falling prices to your advantage. In movies about Wall Street, there is often a character who says, "To make big money, you gotta take big risks." But this is just for the movies, and far from the truth. To focus on avoiding losses, it is better to follow the second core principle: seek investments with relatively low risk and high rewards. This concept is called asymmetric risk-reward, and many successful investors look at it. One example is the well-respected trader Paul Tudor Jones. He uses a 5-to-1 rule to make decisions. He only invests if he can expect to earn at least 5 times his initial investment. So, if he puts in $100, he expects to earn at least $500. By following this rule, Jones can fail 80% of the time and still break even. Even if he makes 5 investments of $1,000, he only needs 1 investment to meet his expectations, which would then earn him $5,000 to be back where he started. And that's if the other 4 went to 0. However, if he is right about 3 out of his 5 investments, he will earn $15,000 and only lose $2,000. That's a pretty good risk reward. As we can see, Jones finds success by following the first and second core principles of investing. He considers the unpredictable market and earns rewards without taking huge risks. Another way to safely increase your chances of rewards is to invest in undervalued assets, especially after the market has dropped due to people's negative outlook on the future. Following the 2008 financial crisis, the market was in bad shape, making it an ideal time to invest in reliable assets that had lost value. Take Citigroup Banking Corporation as an example. In March of 2009, their stock fell from $57 to 97 cents. Yet, within just 5 months, the price climbed back up to $5. That is a 500% increase in 5 months. A smart investor understands taxes to make better choices. If you want to invest, it is crucial to be knowledgeable about taxes, since they can take up a large part of your earnings. That is why the third principle of the Core 4 is to understand taxes. For example, short-term versus long-term capital gains tax, which applies to income earned from investments that you have for less than or more than 1 year. Every state taxes these a little bit differently. It is worth knowing your state's rates and whether you might save money by selling an investment after a year has passed. If you're only a few days away, you might want to wait. It is also helpful to learn about mutual funds, an investment type made up of stocks, bonds, and other assets, pooling investments from multiple investors. If you are considering investing in a mutual fund, know that for tax purposes, all investors are seen as owners and are taxed on short-term capital gains. Since mutual funds trade their shares often, these gains are usually taxed at the higher short-term capital gains tax rate. Being smart about taxes also means understanding the differences between net and gross amounts. If someone says that an investment has provided a high return, you can ask them if that is the net amount or the gross amount. The gross amount, meaning before taxes, fees, any deductions, and the net amount, meaning after taxes, fees, deductions, etc. Obviously, the net sum is a much better indicator of the investment's true quality. It is also wise to search for investment options with the lowest investment fees and taxes. This, for example, might lead you to consider an index fund instead of a mutual fund due to the much lower fees. Index funds don't have managers who charge costly investment fees. They are made up of stocks from an index, like the S&P 500, which includes successful companies like Apple and Microsoft. Index funds are traded only to reflect changes in the S&P 500's composition, meaning shares are held much longer, allowing you to avoid the higher short-term tax rate on gains. Clearly, being aware of taxes and fees will help you make better investment decisions. A diverse portfolio helps protect you from changing trends and market crashes. The fourth principle of the Core 4, which is quite well known, is diversity. Diversifying your portfolio is essential and a time-tested way of safeguarding your investments. It's like saying, hey, don't put all your eggs in one basket. By having a diverse portfolio, you can ensure that even when trends change and unpredictable market shifts happen, you will still have some strong investments. Don't invest all your money into one asset class either, such as real estate. If you do, you might experience a sudden loss when the market crashes for that asset, like real estate in 2008. You can diversify in 4 ways. 1. Across different asset classes. 2. Within an asset class. 3. Across various markets, countries, and currencies. And 4. Over time. Different asset classes include stocks, which are shares of a company, also real estate, and bonds. Bonds being an interest-bearing loan between 2 parties. Incorporating more than one asset class in your portfolio is an excellent way to diversify, as is making multiple investments within the same asset class. Instead of investing only in Microsoft stock, consider buying shares of Apple and Google as well, just in case Microsoft faces a crisis in their specific business. Also, keep in mind that financial markets are global, and you should explore opportunities beyond your country's borders. Lastly, diversifying your portfolio over time means consistently adding capital, whether monthly or annually. The market constantly fluctuates, and regularly adding new capital can increase your chances of catching a trend and avoiding a catastrophe. Trusting your instincts can lead to poor choices, so stay disciplined and use a checklist. We need rules and principles to guide our financial decisions because of how our brains are wired. The human brain can obstruct rational investment decisions since we instinctively react viciously to losing money. We react as we would to a life-threatening situation. The way our ancient ancestors reacted to an approaching saber-toothed tiger is similar to how our brains react to crashing stock markets, wiping out our life savings. Both events are perceived as threats to our well-being, and the natural response is to withdraw and escape. Unfortunately, this reaction is not as helpful in finance as it is running away from a saber-toothed tiger, as the best response to a falling stock market is often to invest more. Remember, low prices are an ideal time to invest in undervalued stocks that can rebound quickly. That is where rules and checklists come in. Before making a hasty decision, refer to a list of criteria to determine the most rational choice. Think of flying a plane. Pilots have extensive checklists for takeoffs, landings, and emergencies to consult before making crucial decisions. Great investors do the same. A good checklist protects you from yourself, transforming your decision-making process into a strict, reliable discipline. Recall Paul Tudor Jones and his 5-to-1 rule. He would not invest or trade without first consulting his checklist, which includes questions like, does the investment have a favorable risk-to-reward balance? And can I expect a 5-to-1 return ratio or less? Now that you are familiar with some essential questions and potential pitfalls, it is time to stop procrastinating and start investing. Financial success and security are within your reach. Regardless of your job or paycheck size, with the right knowledge and action plan, anyone can make smart, profitable investments. And with experience and intelligence, you can thrive even during the most volatile and uncertain markets and times. This concludes Unshakeable.